Welcome back. New producer price index numbers were released in the United States about half an hour ago. As always, those figures give investors important evidence on where U.S. inflation is going, and that can affect the path, of course, of the U.S. Fed and the markets. Let's talk about it with Konstantin Boehmer, Senior Vice President and Portfolio Manager at Mackenzie Investments. Thank you for coming in.
Thanks, Paul.
Just tell viewers that those U.S. producer prices picked up in October, fueled by gains in portfolio management and other categories that feed into the Fed's preferred inflation gauge. Bloomberg News reporting that the producer price index for final demand increased by 0.2% from a year earlier after a revised 0.1% in September. What's your take, Konstantin?
I mean, this is producer prices. Producer prices is a lower tier of the importance when it comes to inflation. So CPI yesterday was a bigger deal, but then again, all of the inflation figures recently have been downgraded in terms of its importance because we have a much bigger story at bay, which is how is the new Trump administration impacting markets? How are they impacting fixed income? And what does that mean for the policy outlook for the Fed?
What is your take on the new political landscape in the United States and how it could affect markets?
So the Trump trade for fixed income was to go short fixed income. Long and bond yields have risen quite substantially in the run-up to the election. And after the election, I think the market is a little bit two-sided. It is, on the one side, we can see that there is a possibility of further government spending in form of tax cuts and just seeing the economy run hot, which was the playbook of the previous Trump administration. And then on the other side, we see the lightning speed of also starting off the Department of Government Efficiency, the DOGE part where Elon Musk is part of it, which is, of course, going in the other direction, which is trying to reduce government spending. And those two forces are currently at play, and market participants are not yet sure which one they're leaning towards. We're probably at Mackenzie, we're leaning, on the fixed income side, we're leaning towards higher bond yields. We think there's a little bit higher pressure that bond yields will continue to rise from here. So a little bit negative in the short run for fixed income on that.
What is we just showed viewers the Canadian dollar. It's been under heavy pressure. The U.S. election has boosted the U.S. dollar. That's a big part of the story. But the other part of the story is market perceptions of where the Bank of Canada is going in this rate reducing cycle versus the U.S. Fed. What is your take there?
Yeah, that is probably the most interesting trade that we can have in fixed income right now. It is two countries which usually go really lockstep with each other. They trade so close to each other. They're, in many people's eyes, they're almost the same economy, but obviously they are not. And Canada is going currently in a different direction. We see inflation actually being somewhat resilient and maybe perking up again in the US versus the same inflation story in Canada going in the other direction. If we look at annual CPI in Canada, excluding mortgage interest costs, we're at 1%. There is no inflationary problem right here, right now in Canada. So that's the inflation side. On the growth side, similarly, you have resilient to quite strong growth with prospects of increasing that in the US versus a quite challenging situation in Canada. So the two major components to determine fixed income and policy rates are going in opposite direction. And that creates a very, very interesting trading environment for trading those two markets in fixed income, but of course also on the currency side, which is the gauge of how are those two countries behaving differently. And there is quite a big difference at this point.
How significant is the risk that inflation picks up in the U.S.?
We will have to see. This is, the easiest answer is always, it depends, but there's so much uncertainty around the new administration that we really have to see what are the next steps. My lean is, given the speed of new administrative posts that have been announced, there's seriousness behind that movement, and as such, I would not discount there to be fairly extreme measures coming our way, and that could freak out or could spark at least some concerns in the fixed income market if it is too one-sided in terms of how that communication goes.